Episode 1, Introduction to Forwards. So we all know that in the market there are three different segments for any securities to trade in. One, equity, second, futures, and third, options. In this series, we will be exploring options in depth. So we all know that options and futures are called derivatives. So what are derivatives? So as the name suggests, any securities whose value is derived from any other asset or entity is called a derivative. And the asset from which the value has derived is called the underlying. An example in the non-financial world can be speed is equals to distance divided by time. Here we can say that speed can be calculated only when you have change in position, that is distance, in a given time, which makes speed a derivative because it is getting derived from distance, and distance is the underlying. So if I draw a parallel in the financial markets, the underlying asset can be anything: a stock, a bond, a commodity, or a currency, and the derivatives are their futures and options. So to understand options, you need to understand what futures are, and to understand futures, you need to understand what is a forward contract. So what are forward contracts? Traces of forward contracts can be found in Kautilya Arthashastra, where he suggested paying farmers in advance for their standing crops ready for harvesting. The forward market was primarily started to protect the interest of farmers from adverse price movement. Futures are a modified form of forwards. So let's look at an example to understand forward contracts. You are a jeweler, and on 15th of January 2021, you made a deal with a gold importer that after 3 months, that is on 15th of April 2021, you will buy 5 kg of gold from him. And the price you both agreed was the current market price, that is 5,000 rupees per gram, which is 50 lakhs per kg, which make the contract value to be 50 lakh per kg into 5 kg, that is 2.5 crores. This is our forward contract. So whatever the price of gold will be after 3 months, both you and the gold importer are obliged to honor the agreement. Since you are buying the gold from the importer, you are the buyer of forward contract and the importer is a seller of the forward contract. So let's understand the mindset of both you and the importer. The importer thinks that the price of gold may go down after 3 months. That's why he wants to lock today's market price. After 3 months, he can buy it at a lower price. You as a purchaser thinks the price of gold may go up after 3 months. That's why you want to buy the gold at a cheaper price. That is today's market price. Now that a contract has been made, there can be 3 possible scenarios. Scenario number 1, the price of gold goes higher to rupees 55 lakhs per kg. You as a purchaser will make a profit this time. Since you bought the forward contract, so you will buy the gold at 50 lakh per kg. You can immediately sell the gold at 55 lakhs per kg in the market. You make a profit of 5 lakh per kg, and for 5 kg you made a profit of 25 lakh rupees. The importer will make a loss here since he has to sell his gold at a lower price than the current market price. Scenario number 2. The price of gold stays at 50 lakh per kg. In this case, nobody will make any profit or loss, as the price remains the same on both dates. Scenario number 3, the price of gold goes down to rupees 46 lakhs per kg. Here, the importer will make a profit as he is selling the gold at 50 lakh rupees per kg, which is worth of only 46 lakh rupees per kg. He's making a profit of 4 lakh rupees per kg, and for 5 kgs 20 lakh rupees, and you will be losing exactly 20 lakh rupees. Now we have understood what a forward contract is. Let's understand what are the risks involved in the forward contract. Number one, the liquidity risk. You want to buy an asset. For that you need a seller from whom you can buy the asset also at your desired price. There might be a case where you don't even get any seller to execute your trade. This is called liquidity risk. Risk number two, default risk. There is a risk that a person who has incurred a loss in the transaction can default the payment. Risk number three, regulatory risk. People can do n number of scams if there is no regulatory body to ensure the fair play. Risk number four, rigidity. So let's say you are in the middle of a trade and you feel you want to change your view from buying to maybe selling. So there is no flexibility in this case. Because of these risks, we need something flexible yet safe, regulated and reliable. We needed something that will keep the core value of forward contracts, but at the same time give us some extra safety net. Therefore, futures were introduced to eliminate the risk associated with the forward contracts. Think of it in this way: if you compare a modern generation car with an old generation car, the modern generation car has the safety features like seat belt, airbags, along with the core function of driving you from point A to the point B. Now we have understood that the futures are the same as forwards, but with just extra features. So let's look at those features once again. Number one, where is my counterparty? It's difficult to find person with an exact opposite view. Here, NSE, that is National Stock Exchange, plays a big role in gathering bid and offer and matching them with each other, and it makes sure a fair play is happening in the market. Number two, futures contract mimic the underlying. So we have understood what is an underlying and what is a derivative. So the future contract is a derivative which follows the underlying asset. So in our previous example, gold is the underlying asset and the future contract or the future price of the gold is a derivative. So if the underlying price goes up, the future price also goes up. And if the underlying price goes down, the future price also goes down. Number three, standard contract. In our example, the trade happened for 5 kg of gold. And if we agreed that could have, let's say, for 3 kg or 6 kg. Futures makes things standard by assigning the lot size to every asset. Number four, easily tradable. I can trade or transfer my contract to some other trader through an exchange that regulates the transactions. Number five, regulated. We have the Security and Exchange Board of India, SEBI, as a regulatory body to see if things are getting done in the right manner. Sixth, time bound. By assigning expiry, the contracts are time bound, like 3 months from our example. And lastly, number seven, cash settled. Most of the future contracts are cash settled. This means only the cash difference is paid out. We do not need to worry about moving the physical asset from one place to another. But with the latest change of SEBI, stocks need to have a physical settlement. For that, you can watch the video on the top, which gives you a detailed view how physical settlement happens. So now let's revisit our previous example of the gold contract between you and the importer, and we will try to look at it through the lens of futures contract. So if I talk about contract value, in our example, the contract value is 5 kg into 50 lakh rupees per kg. That is equal to 2.5 crore rupees. So 2.5 crore is the contract value. If I talk about the lot size, in our example, the 5 kg is the lot size for the deal. If I talk about expiry day is the day when the contract ceases to exist or will become invalid. So in our example, 15th of April 2021 was the expiry day. Lastly, if I talk about margin, in our example, there is no exchange of money at the start of the deal. But in futures contract, both parties have to put forward some token money that is called margin, which is some percentage of contract value. So this is to cover the potential loss that can happen to any party. It is always in proportion to expected movement. Now let's go ahead and draw some parallel between our example and some example from stock market. And we'll see how you can find these values in Sensible's option trading platform. So you just have to go to the web.sensible.com, link is in the description. Click on the option chain, type your asset. For our case, I'm taking the SBIN, that is State Bank of India, for an example. Now you just have to click on this info button and here you can see all of the details. So if I draw a parallel between our example and this particular example, there gold was an underlying asset. Here the SBI, the stock value is the underlying asset, and here you can find it. You can find the futures value here, the lot size and the expiry day. Please ignore the other values. We'll cover it all in details in the later chapters. So now you understand where to find the underlying asset, its future price, its lot size, its expiry day, and other information. Finally, let's see some key takeaways from this episode. Number 1. Futures are the contract between two parties to buy or sell any asset at a specific price on a future date. Number 2. Futures are modified form of forward contracts. Number 3. You buy a future contract if you think the price will go up. Number 4. You sell the future contract if you think the price will go down. That's it for this particular episode. In the next episode, we will discuss the option framework and the two different kind of options, that is call option and put option. Till then, take care.